Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell. Stocks mixed here with healthcare stocks weighing on the Dow. Our very own Inez Ferre standing by with all the headlines. Inez.
Yeah, Josh, we are watching the S&P 500 to see if we get to that record close for the S&P 500 on pace right now, up 0.5%. Over on the NASDAQ composite, up 1%. And then we've also been checking out the Dow that's down 0.8% or about 400 points, weighed by shares of United. United Healthcare. Let's just take a look at the sector action so that you can take a look here. We're seeing technology that's leading along with utilities. As I mentioned over on the Dow, United Health Group, really the one that is dragging on the Dow as insurers are down today because of those Medicare rates that is disappointing to insurance companies. Then just taking a look at the NASDAQ 100, as I mentioned, technology leading. Well, the Mag 7 really leading, except for Tesla. You've got NVIDIA up more than 1%, Microsoft, Amazon also higher as well. The semiconductor space really on fire today as we're looking at Micron up more than 6%. ASML is higher as well. Applied Materials and Intel all higher. Then looking at the crypto space, we are seeing not too much action with Bitcoin hovering above 88,000. Do want to take a look at commodities because we have seen a slide in the US dollar that tends to bode well for commodity prices. So we're looking at crude oil futures that are up more than 2%. Brent crude also up more than 2%. And gold hovering around record highs above 5,000, around 5,090 per ounce. Josh?
Thank you, Inez. Appreciate it. Well, it's a record-breaking day for the S&P 500 today as investors pitting high hopes on earnings season. Roughly 90 S&P 500 names reporting this week, and all eyes, of course, on key tech names after the closing bell on Wednesday and Thursday. Join me now, we got Chad Morganlander, Washington Crossing Advisors Senior Portfolio Manager. Chad, it's good to see you. So we did see that fresh all-time intraday high for the S&P 500 within striking distance now, Chad, of 7,000 here. Big tech earnings on deck. What do you expect to see and hear from those big tech companies, Chad? What's at stake for the market?
Well, it's a fairly concentrated trade with about 50% of the S&P weight going to 20 names. So we're expecting strong numbers on the top line and bottom line for many of the big tech leadership, the likes of Microsoft. You should hear strong top line numbers with strong guidance. So overall, the market is really today favoring large cap tech and as well can continue this trade on for the next couple of days.
You highlight here, Chad, how we could see a pivot, you say, a focus on ROIC for AI projects, so return on invested capital. When do you think that pivot could come, Chad, and what could be sort of the knock-on effects there for high momentum names?
Yeah, well, that's part of the problem because those high momentum names have been a majority of the return over the last 3 years. Eventually, there will be a day where people are going to question the multi-billion-dollar layout for data infrastructure for the AI build-out. And we believe that can come over the next 12 to 18 months. Any type of deceleration or perhaps just a moderation of that capital spend could have some deleterious effects on some of the AI names or the AI adjacent names that have benefited from the infrastructure build-out.
On the sort of great AI bubble debate, Chad, I know some folks, they saw Taiwan Semi's results and forecasts recently, and they said, hey, that they said was reassuring, right? They looked at those numbers, they looked at print and said, okay, this AI boom, it's durable, it's sustainable. Is that how you saw it?
Yeah, well, look, I mean, artificial intelligence is here to stay, and it will benefit productivity for corporations and lift margins over a 5, 10, 15, 20-year period. But you can go through booms and busts throughout that time frame. So one has to be more, I believe, circumspect about where the proper return on investment will come from, where the revenues will come from, And you are seeing many unprofitable names that are real story stocks that have high embedded growth rates that are not achievable, and they're going higher. So we would just caution investors to look at some of the real companies that have more durable types of revenue complexion to them and balance sheets that are sturdier.
I thought this was an interesting point here, Chad. You say more broadly, the 2023-2025 rally, you say, Chad, it was an anomaly. What do you mean by that, Chad? Anomaly? And if it's an anomaly, what could, mean reversion look like?
Yeah, my partner, Kevin Karan, wrote a research report where he highlighted that the last 3 years, when it comes to the S&P 500, over 80% of the return came from market betas of companies with market betas or volatility or lower quality companies above 1, leaving the companies that have less volatility, that are sturdier, more durable, and consistent to not really participate over the last 3 years. And really all you have happening here is that there is just this shift towards volatility. We believe strongly that you have to be much more mindful about the type of risk that you're taking at this point, and just the deceleration of capital spend on a couple of these conference calls from hyperscalers could actually light the match where you get this rationalization in when it comes to many of the lofty valuations for many of these market leaders.
Another thing I wanted your take on, Chad, was what we're seeing with small caps edging higher today, the Russell 2000. You look at the IWM, we're still up about 7% here year to date. What do you make of that move, Chad?
Well, certainly there's been a broadening out since mid-December when it comes to the market in regard to higher quality companies. And we're starting to see that play out in the month of January as well. We assume that as you start to see an equally or a shared distribution between high volatility stocks and low volatility stocks, better known as high quality and low quality, that the high quality companies will start to take on more market leadership and participation. Those companies today are extremely cheap and undervalued. So there are many really attractive names embedded within the top 1,000 names that have yet to participate over the last 3 years. Their earnings have grown, but yet their multiples have contracted.
We got your take on earnings, Chad. I do want to get your take on the Fed, too. You expect the Fed to stay put here. Is that the right call, in your opinion, Chad? When you have this cool labor market, we got more headlines. You saw this today. UPS to cut 30,000 jobs. What do you make of the Fed's decision?
Yeah, I think they should stay on hold for the time being. Yes, there is a deceleration when it comes to jobs. The GDP numbers that are coming out look to be above estimates, due in part to some strong capital spending. But overall, perhaps over 2026, you can see them lower rates by 1 or maybe 2 times. But the expectation embedded in the market right now is for the January number, roughly that they're not going to be lowering interest rates. So we are in line with the general consensus on this go around.
Chad, as always, good to have you on the show. Thank you.
Thanks for having me, Josh.
Well, India and the EU announcing a trade deal today, boosting their economic ties and rebuffing President Trump's tariffs. Yahoo Finance's Washington correspondent Ben Werschel is here with all the details. Ben.
Yeah, Josh. So good afternoon. This is a pretty significant trade deal between Europe and India that was announced overnight. It's a significant change if it's ratified in the months ahead. They've announced that they have this deal, and now they have to work through the ratification process. The terms here are that India is opening its market to European cars, which is a significant change, and both sides are lowering their tariffs on over 90% of what they trade with each other to create what they're describing as a free trade zone of 2 billion people. If you add up both sides of this. And this is the third kind of notable trade pact we've seen since this new year began with without U.S. involvement. Europe also has a new breakthrough with Latin America. That could be on ice for a legal review, but that would be another kind of massive free trade zone they're trying to create between Europe and Latin American countries. And of course, there's been a deal between China and Canada for a couple limited goods, but Chinese EVs would come into Canada, canola oil would go to China, which is a significant first step potentially between those two countries. In the meantime, this comes as Trump himself isn't announcing any new deals and is sort of casting doubt on his previous deals. The back and forth he's had today is around South Korea. He posted on Truth Social last night that South Korea, the government there, isn't living up to their deal and threatened an additional 10% tariffs on top of the 15% that's currently on the country. He backed off a little bit off that a few minutes ago as he traveled to Iowa to say he thinks they're going to work something out there. So that's the latest on the South Korea side.
And Ben, before we let you go, President Trump said to focus on the economy in Iowa shortly. What are you listening for there?
For sure, yeah. So he just landed in Iowa a couple minutes ago. He's going to be visiting with local businesses, lawmakers, and then giving a speech that's scheduled for 4 p.m. This is a speech. This is his kind of, he's promising to kind of travel somewhere in the country once a week to focus on this affordability message. What we're expecting there today is his usual message on that with a farm focus, considering this is Iowa and the farm economy is so important there. Trump offered a little bit of a preview of his message before he left, talked about how the economy is doing great in his view. So we have a lot of positive news to share. That's the message he wants to give. This comes, of course, as Americans are quite dour on the economy in poll after poll after poll. We had a new one from the Conference Board today that showed Americans' faith in the economy is at a sort of more than a decade low. So Americans are very unhappy with this, and these farmers are especially unhappy with this. It's been a tough year in the farm economy, largely because of the back and forth over trade. Trump has offered a $12 billion bailout. China has begun buying soybeans again, but farmers will often tell you that they're far from whole. Trump is being greeted, but as he lands in Iowa just a few minutes ago, with a new letter from the Iowa Corn Growers Association. It's focused on the ethanol issue, but it makes the point that farmers are having a tough time. They're selling their product. Corn farmers, at least, are selling for less than they're making, so they're losing money. And in their words, they're at a breaking point. So his message there, I think, will be especially notable on this farm side.
Great stuff, as always. Thank you, Ben.
Okay.
Coming up, we look ahead to the big tech earnings out later this week and what you need to be watching out for. That's next on Market Domination. Tech giants gearing up to report quarterly results this week, with investors closely watching the price tag for the AI build-out. On Wednesday, we're going to hear from Meta and Microsoft, and next week, Amazon and Alphabet are on deck. In all, the four companies are expected to spend over $400 billion in capital expenditures this year. That's according to estimates compiled by FactSet. And here to decode the AI messaging for this earnings season, we've got Ali Mogharabi, West End Capital Management Senior Equity Analyst. Ali, always good to see you. So let's start at kind of like big picture first, Ali. One big theme for tech investors, it'll be, of course, this AI CapEx spend. And I was messaging with my buddy Doug Clinton today, very smart tech investor and analyst like yourself, Ali. And he was saying, if you look at the Mag 5, Doug said, so he's taken out Tesla and NVIDIA, they're expected to grow CapEx by about, Doug says, 34% in 2026 year over year. Doug is betting, he tells me, no, he thinks it's going to be stronger. He thinks it's going to be more like 50%. So the pace of acceleration is just insane, Doug says. He's never seen anything like it in his career. What do you think, Ali? This AI CapEx boom, does it continue? Could it be even stronger than forecast, Ali?
Yes, we do think it could be stronger than forecast. However, as it accelerates, it also brings with it a lot of other risks. So, as you grow faster, you grow that CapEx faster. I think the investment community is going to demand ROIs on that CapEx, earlier or sooner or more quickly. And there are a couple of names that actually are, where the ROI is the main focus right now. One, obviously, Microsoft that's reporting. Those guys are basically, the demand is not bad on Azure side or AI Azure side. It's just that, they've got a lot of constraints in terms of the capacity side. So let's hope that as they accelerate and as some of the other names accelerate on the CapEx side, the demand will turn into revenue and therefore profits, whether it's on AI specific or overall cloud offerings. So that's just one example.
If I'm betting the AI CapEx boom continues, Ali, though, and maybe it's even going to be stronger than consensus estimates, do I stick with some of those chip plays too, Ali? Do I stick with an NVIDIA? Do I stick with a Micron, a Broadcom? What do you think?
Yeah, that's a good question. Well, I should first indicate that we're not in any of those names anymore. We are actually in one that, in our opinion, holds a monopoly in this entire chip space, and it's the true picks and shovels of chips, and that's ASML. So that's our current holding. But in terms of demand, overall demand for GPUs, and then therefore potentially for additional demand for memory, which is the MU that you brought up, yes, that will continue to increase. However, as you know, NVIDIA is facing additional competition. One of them is obviously Google's TPUs and other ASICs. Amazon, we're hoping, they're going to actually discuss, their chip offerings a little bit more, and their additional investments on that side, generating some additional ROI. So NVIDIA is facing a lot more risks, or competition, I should say. And, the beneficiary of that competition is one of the other names that you mentioned, and that's Broadcom. Those guys are one of the main partners, one of the main makers of those ASICs, especially for, of course, Alphabet's TPUs or Google's TPUs.
Another big theme, Ali, heading into these reports is going to be cloud growth. I'm just curious, Amazon, Microsoft, Google broadly, what kind of cloud growth are you looking for, Ali? Year over year, is it flat? You think it's going to be stronger than expected? What do you forecast?
Well, I think for Amazon specifically, I think it's going to be a little bit stronger. Again, their issue the last few quarters haven't necessarily been demand. It's just been limited. It's just been basically capacity. And as they've accelerated investment on that front, and that opens up their computing capabilities and all of that. So the demand, whether it's driven by AI or just overall continuing cloud transition, is going to turn into additional revenue for those guys. So I think those guys, they're going to see some acceleration on the cloud side. But to answer your question more directly, I do see acceleration on the cloud side of revenue for all of them. But we just think that Amazon's is going to be a little bit faster. And after Amazon, probably see some cloud revenue acceleration on with Google, especially given the fact that Gemini has been doing so well since they came out with Gemini, the latest Gemini version. And, we've seen that with all of the download stats and so forth. So that's going to help them too. And then Azure, obviously still the number 2 player on the cloud side. And hopefully their Copilot or agentic Copilot is going to help them a little bit, although, they are seeing additional competition, and they're actually currently, to a certain extent, utilizing what Anthropic is offering in addition to OpenAI's offerings. So, but I do think that we do think that Microsoft is probably also going to be accelerating their cloud revenue growth.
Ali, traditionally we would talk about that cloud market, those cloud kings, and we would talk about Amazon and Microsoft and Google. Larry Ellison has been muscling his way in as well. Do you like Oracle here, Ali?
Well, we don't have any position in Oracle. I think some of the things that you should look at Oracle is they are burning cash, and at the same time they're increasing their debt to make those data centers. Last time we checked, around $300 billion is needed for those guys. So we'll see if access to capital for those guys is going to be easy enough. And then on the other side, of course, one of their main clients, from whom the demand is coming, is OpenAI. And access to capital on that front is also, I wouldn't say in question, but uncertainty on that front is increasing a little bit. So those are some of the things that we'd be looking for.
Ali, I got to end here with Meta, because my friend Brent Till over at Jefferies, he recently told his clients, this is a name to own. Top pick, he said, Ali. Buy the pullback, Brent says. You agree with that call?
Well, again, I will say we're not in that name. However, I say technically the chart is looking better. That's number one. On the fundamental side, I do track the ad prices, and it looks like the ad prices during the last quarter in Q4 of 2025 have increased around 8.8%, basically around 9%. And that's where the consensus is. The consensus is around 8.5% to 9%. So it looks like on the ad prices, they'll be doing well. Also, guidance on the revenue side could be a little bit better. And this is, again, based on the stats that we track here. That's not only based on ad prices, but also ad inventory. Remember that the midterm elections are coming up, and these guys actually have said that there will be posting, or I should say they will be offering political ads. To a certain extent, they will be limited. They won't be offering political ads until, or I should say, during the last week of the election, before the election. But from now until the election, I think that's going to boost their ad numbers a little bit. So that's to a certain extent, that's a seasonal type of benefit that they will have. But overall, again, just based on some of the stats that we track, it looks like the revenue is going to be better, and they could possibly provide some pretty good guidance, top line guidance.
Ali, always good to see you. Appreciate those previews. Thank you, sir.
Sure.
Coming up, we bring you the top trending tickers on Yahoo Finance. That's next on Market Domination. Now time for some of today's trending tickers. Going to start here with American Airlines, the company missing Wall Street estimates for the fourth quarter earnings. The airline noting the government shutdown negatively hit revenue by about $325 million. Looking ahead to the first quarter, American Airlines also providing preliminary estimates of the impact from this week's winter storm. Revenue expected to take a $150 to $200 million hit. And keeping our eyes to the skies, JetBlue also reporting quarterly results. The airline reporting a wider than expected loss for the fourth quarter. Company noting macroeconomic uncertainty affected its return to profitability in 2025. For the first quarter, JetBlue sees capital expenditures of about $200 million, lower than the analyst estimates of $232 million. For the full year, the airline sees available seat miles growth of 2.5 to 4.5%. However, guidance excludes the impact of the massive storm. And lastly, steel manufacturer Nucor reporting a miss on revenue for the fourth quarter. Earnings also falling below the street's estimates. The steel mills segment in particular, earnings were down due to lower volumes and margin compression. Meanwhile, looking ahead at 2026, the company's CEO is encouraged by robust demand in several key end markets, historically strong backlogs, and federal policies that support the domestic steel industry. Well, GM shares hitting an all-time high off the back of better than expected earnings. And Yahoo Finance senior autos reporter Praz Sumrain is here with the details. Praz.
I mean, look at that stock move, 9% for
wow.
GM, kind of
boom,
unexpected there. But yeah, and I mean, investors taking the good news here. They like what they hear from GM. You know, it's slight revenue miss, but earnings were good. Guidance was better than this year's. For full year guidance, that was better than last year, so positive there. Also, they see less EV losses in that business. They see those EV losses coming down as they sort of rejiggered that. And they took some hits there for that, by the way. But also a $6 billion buyback was also issued and hiked the dividend. So returning cash to shareholders in the face of some things too, like we mentioned. But yeah, a good day for GM stock.
So good day, but what are some potential headwinds? Some potential challenges on the radar.
You know, it's funny. You saw about Nucor stuff. There's the steel. There's headwinds like commodities that they mentioned, but the big ones, of course, are we're talking about tariffs are still there, right? So they booked about $3.1 billion in tariffs this year, and then they see 3 to 4 next year. I mentioned the EV business. They took a big $6 billion write down last quarter, and then they still say that there's still more to come. Now, we spoke to CFO Paul Jacobson earlier today about some of these things. We started off with the Q4 report and what he sees happening in 2026.
Yeah, so 25 was quite the adventurous year as we started with a lot of uncertainty around the tariff environment. And as tariffs stabilized, we implemented the plan that we had begun working on as long ago as November of 24. And I think the team did an excellent job of dealing with the adversity and the challenges that the year presented to deliver the results that we did. And that culminated in what I think was a really strong Q4, picked up a lot of share and continued to see that success. So that turns into the profitability that drives the cash flow engine that allows us to continue to allocate capital in a way that's friendly to shareholders. And I think that topped off what I'm really proud of what the team accomplished in 2025.
So I think CEO Mary Barra wants to return to 8 to 10% EBIT margin there in 2026. You mentioned the tariff exposure, $3.1 billion, I believe, this year, and you're kind of seeing the same next year. Is there any improvement from the White House talking about any kind of improvements there with tariff rates there, or is it still going to be what you think happened this year is going to be the maintain in 2026?
Well, I think when you look at our net tariff exposure, which is our tariffs less our self-help initiatives that we've talked about, we have three pillars: go to market, footprint changes in manufacturing, and then ultimately fixed cost reductions. We were able to offset more than 40% of our total tariff bill in 2025 by just going to work and figuring out what we do as a GM team. And more of that is going to continue in 2026. So, we're very comforted by the administration in terms of their willingness and to work with the U.S. auto industry. I think they realize how incredibly important it is to the country and to our economic health overall. And I think they've been fair in terms of how we have progressed through this and how they've treated it to make sure that the industry isn't put in a difficult position where it can't compete globally. And I think within that framework, we've been able to cut our own path that I think works well for us. And getting back to 8% margins in 2026 is probably about a year to 18 months ahead of where I think investors thought we would be. So that progression has been really good for us to get back to that range and really do what we do.
That leads me to the $6 billion share authorization plan and the dividend hike as well concurrently. Are you able to do that, or GM able to do that because of the fact that you have that tariff exposure, sort of there's more certainty there with that?
So we paused our share repurchases about a year ago as we went through that uncertainty, not knowing what that tariff landscape was. But as soon as we got that certainty, we immediately got back into what we've been doing in that balanced allocation of capital. So we don't see any reason to change that. While valuations have gone up slightly, we're still at a discount to the industry, and we're still one of the most valuable stocks out there in terms of free cash flow yield. So we still have a double-digit free cash flow yield. We feel like the stock is undervalued, and that's why we're able to continue to use our capital and free cash flow to go back and allocate some of that back to shareholders.
So you're generating cash there in the auto business, but then also there's the EV side of the equation is you took a $6 billion hit there in the Q4, I believe, and you might see some hits in 2026 as the business reorient itself. But also I read that the losses are sliding; they're coming down in that business. How do you turn the tide there? And I know Mary talked about how when people go with EVs, they don't want to turn back. So you have some momentum there. How do you keep it going with EVs with the loss of the tax credit in Q3 of last year?
Well, I think the first thing we had to do, and while it's never great to write off capital, sometimes you just have to do it, and that's where we've kind of hit the reset button. If you think about where we've been for the last few years, we were tooling up and scaling up to produce 1 million EVs a year because that's what the government was requiring under the prior administration. So with the changing regulatory environment, we see a much slower path to EV adoption, but we do see a path. So what this is allowing us to do is to continue to drive cost savings and improvements into the vehicle profitability. What we're doing with the new battery technology coming on in 2028 with LMR, which has all the energy density of high nickel, but at a cost that's more like LFP. It's going to allow us to save thousands of dollars in the vehicle. So we can do that on lower volumes going forward. As far as demand goes, I think it gives us time to get the charging infrastructure up and ultimately get people more accepting of EVs, because when you look at the product offering and what it can do for a consumer with the technological capabilities, et cetera, it can be a superior driving experience. But people are going to have to test that, and we're going to have to get over some of the charging anxiety issues, get more chargers out there, and that's going to continue to drive demand. And I think we can be in a leadership role, especially now that we've reset our capacity to be more efficient going forward, and that will save us thousands of dollars per vehicle going forward and ultimately help us back on our journey towards profitability in EVs.
New Bolt EV coming out, I believe, this year too, at a cheaper price point as well. Does that help you sort of get back to 100,000 EVs a year? Is that possible again, or is it going to be a slower game plan?
Well, I think we'll probably do about 5 to 7% EV adoption. We think that's where the trend lines were before the IRA and the consumer tax credits came into place, and that's kind of where we've settled out. Although it's been a little bit noisy since September, and we expected that. So I think over the next few months we'll get a better idea of where demand is, and I think it'll steadily go up there. When a customer drives an EV, we see about an 80% retention rate where they say that they want an EV for their next vehicle as well. So it's going to take a little bit of time, but we've got the patience, and I think we've got the capital to be able to do it.
I see that 01X behind you, and on the flip side, the powerful V8 engines there. So, I want to talk to you about gas-powered cars, building in America. How do you increase that exposure to the U.S. Manufacturing and still keep costs down? And by the way, you're still seeing a $16 million SAR this year. Is that going to be driving that? Is it all about gas and hybrid cars?
Well, obviously with the regulatory environment, it allows us to sell more of those ICE vehicles that consumers want and demand. And I think we've got a great franchise, all across the board for all price points. Last year, we sold over 700,000 vehicles with a price tag less than $30,000. So it's been an incredible run. And I think our portfolio really speaks to every customer wherever they might be on their price points. And that gives us a leg up, I think, on the industry and allows us to pick up some share. So that's going to continue. And when you look at driving that cash flow, what it's allowing us to do is reinvest back into America. So we've got about $5 billion of capital that we've allocated to onshore production. And we think by the time we get to 2027, when many of those projects come online, we'll be producing nearly 2 million vehicles a year in the United States.
U.S. consumer confidence dropped sharply in January, hitting its lowest level since 2014, as Americans remain concerned about their financial future, with inflation remaining one of the most important issues. According to the Conference Board, Yahoo Finance executive editor Brian Sozzi breaks down how inflation is calculated and the difference between CPI and PCE.
Inflation is at the top of everyone's mind right now. Why, you ask? Because when they go to the grocery store, they're worried about paying higher prices for beef, poultry, cereal, toilet paper, paper towels, you name it. Now, we all know that inflation means an increase in price, and we're going to break it down for you right now. There are two primary ways to measure inflation. First up is the CPI, or the Consumer Price Index, and the second one is the PCE, the Fed's preferred inflation index, known as the Personal Consumption Expenditures Index. A mouthful, but very important. CPI is the one we hear so much about. It helps determine Social Security and cost of living adjustments. And of course, it's so important because it measures prices we pay in the U.S. economy for things like food and energy. PCE is the Federal Reserve's most favorite indicator of inflation. Guys, they love this measurement. They use it primarily to help set interest rate policy in the United States. Each index weighs goods in their baskets. One index may place more value on a good than another. Another is the math behind these two indexes. How they are calculated are very different. For example, PCE reflects spending at rural households and even nonprofit organizations. These are the major differences between CPI and PCE.
Coming up, Samsung's Trifold phone is coming to U.S. stores on Friday. We'll get a look at that device next. Don't go anywhere. Samsung is pushing the limits of smartphone design and pricing with a new foldable device. Yahoo Finance tech editor Dan Howley is here to tell us more. Dan?
Yeah, Josh, this is Samsung's Galaxy Z Trifold. Okay, it has two folds, so maybe not necessarily tri, but it does have three screens. You can see here, those are some handsome hands. That's me at CES playing around with it. And you can see that it unfolds into that large display. It's about the size of an iPad when it's fully unfolded. The front screen, that's about the size of a regular smartphone screen. It's a little bit narrower than the standard that you would have from one of Samsung's Galaxy S series phones or your standard iPhone, but it does do the job. The big thing here is if you're really heavy into productivity, you want to be able to open multiple apps. They actually designed this to act kind of like a PC where you can open an app and kind of move it off screen and then have another one down here. And you can have your windows kind of all over the place. You can have dual apps going at the same time, things along those lines. If you don't want to do all of the business, rigmarole, you can also watch movies, play games, things of that nature. It is a tad thicker than a regular phone when you're holding it, but when you unfold it, that's crazy. It's bonkers how thin they managed to make that. The USB-C port, that's the port they use to charge your phone every night, that is the only thing that's keeping it that thick at the bottom. If they went any thinner, they couldn't fit it. So it's a wild device. Big old price tag, though.
How much are we talking?
$2,899. Wow. That is an expensive phone, But this is really for enthusiasts. Samsung isn't expecting this to be like the big, sales device that they have when they have their flagship, S series. This is supposed to be for
limited
enthusiasts.
volume, high margin.
High margin,
Yeah, right,
high margin.
right.
And just proof that their technology is at a point here. I mean, I remember when the original foldables came out, and you were like, all right, well, there's this big crease and, all that good jazz. You can still see a little bit of a crease. You're going to anyway, because it's a folding phone.
Yeah.
But, I mean, it does look crazy when you hold it. It really blew me away.
So let me ask you this before I let you go. All right, that's Samsung. Got rumors, reports, speculation about Apple. They're foldable. What do you think? Fall 2026 on the way?
Murmurs, rumblings.
Yes.
The idea is that Apple's going to launch this foldable iPhone in September. It would be their big, huge step into foldables. That is supposed to kick off this huge cycle of people buying foldable phones and iPhones. Look, foldables have been around for a while. They actually started to pick up with Samsung's last Galaxy Z Fold, the Z Fold 7. They started to see an increase. More people are getting interested in it. And I'm starting to see them anecdotally more around New York. When I was over in Korea a few years ago, I saw a lot of people have had folds there. Still more people than not had iPhones. That's in Seoul, of course. But I think that if Apple gets in there, Samsung's continuing to prove this technology, we'll start to see more people finally get into the foldables. It's not going to be the main thing that people buy, though. I think it's still going to be the regular candy bar style phone. But I think for a lot of people who may go for those high-end devices, the foldables were to go. It's also just fun to finally get something that's different in terms of design rather than the same phone that we've had for years and years.
100%. All right, I'll wait for the Dan Halley review, though, of course, as I do.
Everyone should
As I
wait
do.
for the Dan Halley
That's
review.
just good advice.
Get more
That's
camera
sound advice.
time for those hands. They're very handsome.
All right. Thank you, Dan Halley. Appreciate it. NVIDIA is shaping up to surpass Apple as Taiwan Semiconductor's top customer in 2026, a shift that could reshape the chip sector. For more, we're bringing in now Ben Beharin, CEO and Principal Analyst at Creative Strategies. Ben, my friend, always great to see you. So let's dig in, Ben. You get this new post on your Substack, where you make this interesting point, Ben. You say you see NVIDIA overtaking Apple as TSMC's biggest customer. Just walk us through that, Ben, and what you say there. What is the trend?
Yeah, so I think this has been inevitable for some time. I mean, anybody who's looked at revenue contribution by customer, probably for the last year, has just seen how much NVIDIA has gained and why they were on track to basically surpass Apple. They've been pretty close, and I think 2026 is the year where they do become TSMC's largest customer by revenue, right? And I think that signals a couple of different things. If you just look at TSMC's earnings, you see the shift to HPC, so high performance computing, is the vast majority of their revenue. That's only going to continue to grow. And that's just a big shift from the days of mobile, right? Where Apple was really the predominant customer chewing up wafers for, iPhones and iPads and Macs and whatnot, to this space where we're in with this AI accelerator segment starting to take up so much more capacity, really driving some of the vast constraints that we see in semiconductors holistically across the board. So it's really just a change of structure, a sign of the times. Apple's still relevant to TSMC pretty significantly in terms of wafer consumption, but the wafers and the work and the advancements in capacity and CapEx that TSMC needs to do for NVIDIA and others is very different than what they had to do the last 10 years for Apple.
So let me ask you, if I was an Apple investor and I'm listening to this, and okay, TSMC's new biggest customer, NVIDIA, not Apple, how should I interpret that, Ben? Does that suggest that Apple is in any way less of a priority to TSMC?
No, I don't think so. I think they're, again, strategic priorities in different ways, right? So Apple makes, monolithic chips, right? So it's one chip per device, right, as a part of the overall wafers. And so that process is not going away. When you look at what NVIDIA does, that's a multi-step process. GPUs are much larger per wafer, and as they use advanced packaging, there's more steps involved to get from GPU to GPU package, right? That goes in NVIDIA's product. So I think they're both still significant. It doesn't change also the shape of Apple's growth direction. There's still demands across the board for Apple products. We don't see that changing at all. It's just, I think it just shows the diversity that TSMC is going into right now. And, I think a bigger question is this opens up, does Apple start to look at other sources again? Again, Intel has come up, right, as a foundry, potential choice for some Apple products, obviously not sort of the mainline ones, but we are up against a supply constrained manufacturing environment in foundry. And that just creates dynamics of challenges for everybody, right? That's going to be true of NVIDIA, it's going to be true of Apple, and they need to navigate that supply chain. So it's really just, again, a structural sign of the times that we're in relative to AI, but I don't think it changes the priority that Apple has still at TSMC.
Let me ask you, Ben, you mentioned Apple demand, Apple products, so let's talk about that, because you got Apple earnings on deck. Longtime Apple watcher, Apple analyst that you are, Ben, what do you expect to hear? Not just about the quarter, but what do you think they signal and suggest about the quarters ahead?
Yeah, I mean, I think we still anticipate a strong quarter. There's been a ton of signs just showing that the demand has still been there for the latest generation iPhones. Again, to the degree that some of this is pull forward demand, I know that management, doesn't believe that's the case. But are people concerned about, raising prices of devices because of things they hear in the market, not just in, inflation, but memory, storage? So are they buying early? Right, that's part of the question. Regardless, we think that they're still going to have a strong quarter. And I think what most people will be interested in is what are the signals saying for the next couple of quarters. I think there's an anticipation of a lot of new products coming from Apple in the spring quarter. And obviously then right into the end of the year. And there is a concern around, memory prices and storage. And so how they balance that with margins, I think people will be really, really curious about that. Are the, impacting prices of memory and storage, giving any signals to demand? So I think there'll be a lot of questions just hunting for some of those, because there is a lot of angst in the industry, largely that those price increases do hurt buying trends.
What about the Siri revamp, Ben, in March? What are your expectations there? What do you think that could mean in terms of the iPhone upgrade cycle?
Yeah, I think everybody's gotten a lot more optimistic, to be honest, Josh, that it sounds like there's a partnership with Google for Gemini Flash, which, I'm a big fan of. I've used Gemini a bit. I think it's a very capable model, especially for multimodal things like being able to see what you're seeing with the camera and give you information about that. So I'm optimistic that that's the right foundation or the right piece that comes to Apple foundational models. And I still think it's really going to be the story that they tell, right? What is AI on Apple devices? What is an enhanced Siri and perhaps a much more capable personal agent mean for you? How does that hook into their operating system, bring developers the opportunity to build new apps? And so I think there's optimism. I think the last couple of years we've talked about this for over a year now, right? About what will this bring as a demand cycle for AI or a pull. We're still skeptical, but I think if Apple tells the right story, that will definitely help, the rest of this year drive some demand where people want new capabilities, in this case, AI on their iPhones coming from Apple from later this year.
And finally, Ben, I got to ask you, I thought when I saw this headline, Bloomberg's Mark Gurman, you saw this, reporting Apple expanding the job of hardware chief John Ternus to include design work. Solidifying his status, Gurman saying here, as the leading contender to eventually take over from Tim Cook. Mark does add no signs within Apple that Cook is poised to step down soon. But I know you saw that headline, you saw that report. What do you make of these shifts, Ben, and what could be coming?
Yeah, I'd interpret them the same way, that there's still an increase of leadership roles that's taking place as, new leadership, I think, comes to Apple at some point in time. I do not expect Tim Cook to go away anytime soon. Even if there's a transference of the CEO role, I expect him to still stay involved at a chairman level and whatnot. And even within this, despite, the leadership roles and increase of roles for John Ternus, that's also happened with Craig Federighi in software. And so I think there's a lot of signs out there that point to these two individuals will be very, very closely aligned in running Apple, even if, one is the CEO and one is something else, right? CIO, CTO, whatever. It feels like that's going to be those two kind of at the hip, co-running Apple and leading it into the, next decade plus. So I would interpret those the same ways. But again, don't see Tim Cook going anywhere anytime soon.
All right. Nobody better at breaking down all things Apple. Ben, thank you as always, buddy. Appreciate it.
Thanks for having me.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.